This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 288 was recorded on September 9th, 2021. I'm Erik Townsend. This episode is brought to you by Abaxx Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole, and by escrow.com, the world's most secure online payment system from a counterparty risk perspective because the funds sit in escrow. View from the Peak founder Paul Krake returns as this week's feature interview guest. We'll discuss what Paul calls megathematics, the important trends to watch in the current macro environment. Patrick Ceresna is off this week. Kevin Muir joins me as this week's co-host. And be sure to stay tuned for our Postgame segment when Kevin and I will discuss the U.S. Economic Surprise Index as it relates to inflation.
Erik, great to be with you. Let's jump right into it. What are you seeing this week in the S&P 500?
Absolutely nothing that I haven't seen the last umpteen weeks, which is the melt-up continues. What's it been, all of 3 days now that we've gone since the S&P showed a new all-time high, and already people are panicking. At some point, Kevin, you and I both know this has to end badly, but I don't think it's anytime soon.
It is been a slow summer. It's one of those things that you were better off just taking the month off and RVing across Canada.
Is that what you did?
Yes, that's what I did. Okay, so let's talk about the next asset that you love talking about is the U.S. dollar. Anything exciting happen there this week?
Nothing whatsoever. Nothing to report. Summer doldrums again. You know, until we see a daily close below 89 or above, 93.5, 94 in there somewhere, we're consolidating. And I think that consolidation is likely to continue for an extended period. Why? Because nobody's really sure what to make of monetary policy. It keeps changing.
Well, surely there must be something that you can say about crude oil that's different.
Well, I've always got something to say about crude oil. I think what happened this week was we had what would have been a very bullish inventory report. Somebody probably saw that coming. So what happened was we got the famous, let's release the bearish data just a few minutes before the inventory came out. So China announced that it, back in July, had released some oil from its SPR. Now, obviously, what happened past tense back in July is not relevant to the market. But what is relevant is the signal that sends around potentially China's future intentions to sell off more of the oil that it's accumulated in its strategic petroleum reserve. That sent the market basically crashing until EIA inventory came out this morning, delayed until Thursday this week because of the holiday. Crude oil drawing down 1.5 million barrels. Now, that's a significant drawdown, but not a monstrous one. Cushing, Oklahoma, drawing down 1.9 million barrels. Well, where's the monstrous drawdown? It's in gasoline. 7.2 million barrels of gasoline drawn down, and another 3.1 million barrels of distillate. So 10 million barrels of finished products, in addition to 1.5 million barrels of crude oil, was drawn down last week. U.S. production collapsing all the way down to 10 million barrels. That's down 1.5 million barrels from last week. That's not a new trend, folks. That's entirely hurricane related. So anytime you have a hurricane weather event, it basically invalidates a lot of the inventory data for several weeks, until we get back to normal. So I don't read too much into that. But in general, I think we're trying to break through a resistance level and get out of this downtrend and resume an uptrend. I think it would have happened today if not for this news release out of China. And it looks like what happened was we were down on that. Then inventory came up and it was right back up to the numbers we were at before the China news. Now it seems like inventory data is wearing off. We haven't gotten to the close yet. We're recording early this week, but we're almost down to the 100-day moving average. If we close below that, it could be another wave down to a new cycle low, down maybe below $60. I'm leaning the other way, at least I have been until today's tape action, which is I thought we were about to see an upside breakout.
Sounds like some other people, apart from me, had the idea to go drive across the country, and the big gasoline draws might be indicative of more Americans doing that.
Well, that may be. You could be responsible for the new trend, Kevin.
Okay, let's move on to gold. Is there anything new that's caught your eye there?
Well, as I said last week, what we were waiting for was to get above those long-term moving averages. And I said we need to get a close above 1820 and stay there for a few days. Well, guess what? We got the close above 1820. We didn't stay there. We went straight back down the very next day. And at this point, we're back down to the lower end of the support range. And it's going to be really interesting to see what happens. I thought we were going to see an upside breakout, but a fake breakout is a very bearish technical signal, particularly if we get a daily close below that cluster of moving averages. The bottom of them looks like it's the 21-day moving average. It's 1795. If we get a daily close or a weekly close even below that, it suggests we might be headed down to new lows below 1680.
Well, one of the things that might be weighing on the gold market is the bonds. Bonds seem to just be grinding higher in terms of yield. What do you see there?
Well, I don't know what to make of yields. Everybody, I think, gets caught in this mental trap where they say, surely the 35-year bond bull market must be over now. So that means there has to be a 35-year bond bear market starting, and it's time to short everything. Well, wait a minute. End of World War II, it took 10 years for interest rates to bottom and it's finally turn around. It could be it takes several years, and I think there's lots of reasons to expect the rest of the 2020s to be a very low interest rate environment.
Well, thanks for those updates, Erik. This week's featured guest is View from the Peak founder, Paul Krake. Erik, why did we invite Paul back to the show?
Paul is a really smart macro guy, and we've had him on the show before. With everything that's going on with respect to inflation and everything else, I wanted to get him back on the show for an update, and I think it's very timely because you'll hear a lot of his views are very pertinent to a lot of the concepts we've been talking about on MacroVoices in recent shows.
Erik's interview with Paul Krake is coming up as MacroVoices continues, right after this message from our sponsor.
This episode of MacroVoices was brought to you by Abex, a fintech company traded under ticker symbol ABXXF on the OTCQX in the United States and ABXX on the Equitas Neo in Canada. Abex was founded on the principle of creating market-based solutions to solve the world's most challenging problems. Two of these issues in particular, the energy transition and climate change, are creating once-in-a-generation opportunities for investors. Abex is leveraging proprietary Web 3.0 technologies to digitize and accelerate the velocity and security of commodity trading markets, beginning with liquefied natural gas and carbon. Investors seeking exposure to the fintech applications powering this new era of the ESG economy can visit www.abex.tech or www.abex.exchange, or check out ABXX on the Equitas Neo or ABXXF on the OTCQX exchanges.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Paul Krake, founder of View from the Peak. Paul, it's been several years since I had you on the program. It's great to get you back. I want to imagine, because so many people have said that in finance, the week after Labor Day tends to be kind of when the big boys get back from the Hamptons and things start to move. I want you to imagine you've been running the macro desk for the biggest bank in New York for the summer, and the big boys are back from the Hamptons, and your job is to brief them. What are the macro trends that they need to be thinking about? What are the thematic macro things that are on the horizon? What should they be thinking as they take over the reins of the macro desk?
So, Erik, am I in the office or am I still at home?
I don't know.
Because again, that obviously is a big part of it, right? Because if you're looking at this, if you look at the world through a traditional macro lens, a lens that I think is structurally flawed, and we'll get into that a little later, but this rolling 3 month cycle that that the macro world tends to live in. Obviously, if you're looking between, let's take it a little further and say now and the end of the year, you've got I think there's two major narratives that you need to think about, or three. Firstly is COVID and the transition towards the reopening world, Delta variant, then the vagaries around that. and how that's affecting different parts of the world, putting them in different cycles and the like. Secondly, and most pertinent to the value of asset prices, is the prospect of tapering. Do they, don't they? When does that begin, and how does that work into the economic framework that we look at going into 2022? And the third thing, which again we are looking through this rolling 3 months window, is common prosperity, is the notion of what China is doing. And that, Erik, I assume we don't have 5 or 6 hours for that, to explore that in the depth that deserves. And I think if I was to make one observation at the morning meeting at my very large investment bank where I run macro, I would say to everyone that to look at this through a blanket approach or a singular lens is the wrong way to look at China currently, because it is much more nuanced and complicated than most people think. And frankly, that framework of China and common prosperity is more than a 3 month view. And I think, frankly, the other stuff of the lingering effects of COVID, or what I call COVID scarring, how that plays out, and obviously the implications for tapering, a rate tightening cycle. Do we actually get to that rate tightening cycle? Obviously goes further than the end of the year, but within the 3 month window, that's what we think you should be thinking about.
I like some of the longer term thematic things. So beyond China, what other thematic macro trends should we be thinking about?
So, Erik, the way I'm sort of thinking about this, and I think it's my own deficiencies, but I'm not going to be the one who takes on the algorithms that win. So, within that 3 month window that I was talking about, I mean, the ability for you and I as human people to outperform the machines is remarkably difficult, and we've got every year that goes by shows how much more difficult that process is. So, and I think before we started recording, we started talking about changing the framework for macro, and I think we need to be doing that and trying to look through a much further time frame. And obviously that's easier said than done, because we are victims of mark to market, and and the embedded volatility and the vagaries of prices, which you and I can't have no control over, can stop us out of the best laid longer term thinking. But no, I'm looking at the world through what I call megathematics. And, obviously you have to have a bunch of assumptions when you look at the world through megathematics. I'm a believer that rates will not rise for years to come because of my inherent disinflationary biases. So that's part of it. Let's word it slightly differently. If you were going to build a research business, or you're going to build a trading business, what areas should you look at? How should you bucket the research process, right? So everyone's got to have a climate bucket. So you've got to be doing climate research, because you can't do research on China, you can't do research on the ECB, you can't do research on oil and gas without looking at that through a climate lens. Goldman says $50 trillion by 2050 is going to be spent to decarbonize the world. All right. So let's say there's a margin of error of $20 trillion aside on that, right? It's a big bloody number. Right. So climate has to be front and center in people's analysis for the next 2 decades, 3 decades and beyond, because it's going to be the epicenter of everything. China is going to be the world's largest economy. Most of us are deeply skeptical about Chinese data. The one data point you can be confident in is it's got 4 times the population of the United States, and eventually it's going to be the world's biggest economy. Now, whether that's the world's biggest economy that has truly outsized global influence, whether it's the world's largest economy where its asset markets are reflective of its economic might, whether it's the world's largest economy and looking inward from a technology perspective, whether it's the world's largest economy with a currency that is a true rival to the dollar, where they're all things that remain to be seen. But the amount of funds that I know of, be them macro, be them global long short equity, be them credit, who don't have dedicated China research, I think exposes the flaws in the ways that we're looking at macro markets, because China does dominate a lot of them. And then you've got other big mega themes. Demographics is one of them, obviously, which there's a Japanification of the world argument that goes with deteriorating Western demographics. You can look at AI, you can look at biomedical, you can look at digitization. We can debate whether crypto and blockchain deserve to be in the group of mega thematics. And then for me, the one that I'm very, very focused on longer term is the notion of what I call the transformative 20, which is the 20 companies that I think will redefine the ways we work, we shop, we travel, we communicate. And every decade since you and I were boys, every 10 years, the top 10 market cap companies changed. And I believe that cycle has come to an end. So, Exxon was once the world's biggest company, but Exxon will never make cars, where Tesla can be the world's most profitable energy company. And, Pfizer can never do search, but Google can do healthcare. And if I'm Jamie Dimon and I'm looking over my shoulder about who my biggest rival is, well, it's not HSBC or Citibank, it's probably Amazon. So the addressable market for these 20 companies is simply remarkable. And I think that, for me, you've got, if you as a macro investor, and I get this is a cliche that Google's the new dollar yen, but you've got to have a handle, if you're a macro investor, on what those 20 transformative companies are doing. The fact that the majority of them are domiciled in the United States, for example, has real implications for the value of the dollar. Are you going to see structural dollar weakness if the world's greatest companies remain domiciled in the US? It's an open-ended question. So there's some of the sort of the way I'm sort of viewing the world, which is, and again, I don't use the word macro like I used to, Eric. In fact, I run away from it a lot because, macro does have a rates and currency connotation. And, rates around the world are anchored at zero, and the Sharpe ratio of currencies is what it is. To be a true modern macro investor, macro has to have a broader definition.
I want to come back to climate and the tapering and a lot of the other things that you mentioned in that first answer, but let's start with China and really focus on China. Tell me what you mean by the situation in China, because I've talked to some people who've said, look, the situation in China is bad. They're really struggling under, COVID and lockdowns. And boy, the Communist Party could risk losing power because of how bad the situation is there. And I talk to other people and they say, look, China's clearly got a plan. We've got a very realistic risk of them starting World War III with the United States and winning. Okay, wait a minute. Those are two very different stories. And yet I hear lots of people sort of all talking about China as the most important thing, but they've got wildly different views on what's happening in China. What's your take?
Well, and there's also a third one where China just does what it does, looks inward, becomes the best society it can be, and doesn't really have global ambitions of a military nature. Right, so there's all these things. Now, let me give you the optimistic version of this, and where I think that the uber bears who have consistently gotten China wrong, right? So let's start with the framework of why they've gotten China wrong, right? And I'm not talking about those who have been bearish on China for 5 years or so. Let's go back to Deng Xiaoping, right? So the two great foreign policy mistakes the United States made in regards to China was a belief that you couldn't have economic prosperity without political freedom. And to go back and quote Bill Clinton, that controlling the internet is like nailing Jello to a wall. Well, China jailed Jello to a wall, right? And the third one, which my good friend Louis Gov was talking to me about recently, Louis made the point that maybe you can have a closed capital account and still be on an organic path to being a reserve currency. So there's all these misconceptions that have been made against China. And certainly, look, let me start by saying I'm not here to defend the indefensible in regards to the actions of China domestically. I mean, their behavior over the years in many ways against against the Uyghurs in Tiananmen Square back to 89 and the like has been absolutely abhorrent. But it doesn't mean that the model is going to fail. So, you get to the rise of Xi Jinping, a new style of leader, a leader who has taken very much a Maoist view on having the charismatic leader that the party can get behind, and sees that the Western world is pushing back against China in a myriad of ways. You've got semiconductor embargoes, and you've got a force for issues over be it sanctions over human rights, and the Chinese feel that they are under siege from the Western world. I mean, China never tried to deliberately destroy a global brand like Nike or Starbucks, but Huawei, China's true global brand back in the from 2015 onwards was under systematic attack to put it out of business by the Chinese government on the basis of intelligence which was flimsy at best, right? So China feels like it is under siege, and China has an energy vulnerability. It has a technology vulnerability, as was exposed through the semiconductor embargoes, and it also has an over dependency on the US dollar, which is playing out through a slew of changes that are being implemented right now. So that's the framework that I think is in place. Now, let's look at the blanket approach that people are taking to China, an approach which I think is deeply, deeply flawed, right? So suddenly China is uninvestable, and you've had these draconian measures against Ant Group and against Meituan and against Tencent and the like, and it's making China uninvestable. And it's a sign that the fragility of the Chinese Communist Party, because they have to clamp down on these great companies to control them. Or they're just doing what every other country in the world wished it could do. So, Eric, just think about this. So my 14-year-old, when I told him that kids in China were banned from playing video games only could play video games for 3 hours a week, the look of horror on his face, as in he looked like he wanted to get on a plane and fight for the rights of Chinese teenagers to blur their eyes with video games, right? But you ask me, you ask other parents, and a ban on and restricting access to video games, maybe not a bad thing. Maybe not a bad thing, right? Meituan comes out and it gets a fine because it doesn't pay its drivers minimum wage. The stock's down 17%, and Meituan is uninvestable. Until you realize that that's the same thing California and London did to Uber. Data privacy provisions. The new data privacy laws are very, very similar to GDPR. Right, so I think what we face is a massive, massive double standard here, and a good example of this is as follows: Tencent gets a $50 million fine over Tencent Music in terms of an acquisition that created a monopoly of 80% market share in music streaming for Tencent Music. Right, on the same day, and the stock's down 8%. Same day, the EU fines Amazon 900 million euros. For a breach of anti-competitive regulation in Europe, right? 900 million euro fine. Stock doesn't move, right? China is uninvestable because it's putting anti-monopoly regulation on its companies. EU does that to Amazon, and that's okay, right? So I think that if you look at a lot of the tech regulation that you have witnessed, it's really popular. It's really popular, right? Because we have to, at all times, distinguish between the Communist Party and the Chinese people. And the Communist Party is all powerful and the like, and we have seen them do, think whatever they want. But enforcing regulation that's popular amongst the people is a hell of a lot easier, right? So Chinese consumers are no different to British, Australian, American, or Canadian consumers. They know when free is not free. They know when they're getting screwed. They want their privacy protected from companies who are going to abuse that data. So therefore, a lot of the measures that we have seen, and particularly the measures that we saw in regards to for-profit tutoring, which was extreme. And by the way, we saw something similar in the United States in 2010 when President Obama banned for-profit private student loans. This stuff is really popular. So the optimist in me says that a lot of the measures that we have seen related to Chinese tech are measures that the US wished it could do, but it has a polarized political model that means that, frankly, not a lot gets done. And the EU, does have GDPR, but GDPR took years to implement because you've got to have 27 countries in consensus for things like this. These measures look really harsh in China, but the party being the party means that it can get stuff done.
I want to ask you about a specific aspect of this China situation, which is Hong Kong has served for decades as kind of the Western liaison or gateway city to Asian finance, to the point that you and I both have been Hong Kong residents, but neither one of us is spending our time now in Hong Kong because of the changes there and the loss of independence that's occurred. What does this mean for the finance industry and for Hong Kong? And does Singapore come into the equation?
I think that Hong Kong plays a vital role, particularly in the context of what I think is the inevitability of the delisting of Chinese shares from US exchanges. I do think that's coming. I don't think that's avoidable because at the end of the day, China views data as through a national security lens, and the Chinese are simply not going to let Chinese regulators fly to Shanghai and go through the books and records of its strategically important companies, right? And I think what you'll see with Hong Kong is going to play a vitally important role in the next 3 years as being the safety valve that allows those Chinese firms that are listed in New York on the Nasdaq or NYSE in particular to move to Hong Kong if they haven't already done so. So I think it plays a very important role in that regard. But look, longer term, purely from a capital market standpoint, the regulatory environment is going to morph more towards the Chinese regulatory environment than having its own Hong Kong's own independent regulatory environment now, and that's purely from a capital market standpoint. Look, I don't think there's a threat to the Hong Kong dollar anytime soon because obviously that does create the it's the organic source of a separation between China and Hong Kong, which look eventually goes away. I mean, the joint declaration as it stood when as Deng Xiaoping referred to her as that woman negotiated it, it doesn't resemble what Thatcher put together. Right. And it wasn't the intention of what Chris Patten was thinking about in 97. And, so I think that, Hong Kong is not the place that you and I fell in love with. It is, it's an incredibly problematic place, not only less so for expats, but it's certainly not an appealing place for expats to live like it used to be. Certainly a very problematic place for Hong Kong families who have been there, who are Indigenous Hong Kong families who have been there for a very long time. Look, I think the future is very bright for Hong Kong as a capital market as this transition away from capital formation in the United States. It takes its path, and that could be another 3 years. Singapore will be always there in the periphery, but from a capital market standpoint, Singapore has continued to be a constant sort of disappointment in that regard. So I think there's life in Hong Kong left yet. I think that again, it's all about the capital market side of things, and the place you and I fell in love with, it's not that place anymore.
Paul, when you introduced the concept of megathematics earlier, you mentioned climate as one of the important considerations there. Let's talk about climate and also this broader ESG trend, which frankly I think is more marketing than reality. What do you make let's start with climate, what's important there, and then how well is Wall Street responding to that need with its ESG offerings?
Yeah, and it's so just to make the point, Eric, that we run we're launching a whole product called Climate Transformed, and you will not see the word ESG anywhere in what we do, right? Because we don't do ESG, we do climate research, and it's very, very different, right? So I think of ESG as a fiduciary obligation. I think of it as a legal and accounting way of organizing oneself, where what I call climate research is investing in climate technologies and climate companies that are going to help in this decarbonization process. No, I think it's vitally important, not just through the sheer numbers of the sheer amount of dollars that will have to be spent in this decarbonization process, but I think the ECB is a wonderful example of this, who is prioritizing carbon related infrastructure as part of its agenda. And I think that's a remarkable development, which will mean, talks about the monetization of green debt, the ability, make it much easier for deficit spending on European infrastructure. Obviously there's massive asset allocation switches in regards to what industries are investable and the like, which that is part of the ESG angle. And I think just as investors had the right to pick and choose whether they wanted to invest in tobacco, I think that investors should have the right to pick and choose if they want to invest in carbon in carbon heavy industries. But I think that there's that angle. I think there's the angle of, from a research perspective, of really trying to quantify what the carbon bills are going to be for a company like Total or BHP or Freeport or whoever it is. And it's hard if you try to find estimates of what the carbon liability is for these companies, it's really difficult to do. So I think that the amount of research that has to go into this is going to be just enormous. And I wrote on the weekend that I think that if we're rethinking the way that we build a research firm, you don't have mining analysts and oil analysts and utilities analysts and mobility analysts or autos analysts. You have them all under the climate bucket, because the regulatory frameworks, the taxation implications, the funding implications are going to be relatively homogenous across a lot of these sectors. But the big one for me, and the big challenge, Eric, that I face for someone who has been a card-carrying disinflationist for a very, very long time, is the notion of the inflationary impacts of the climate adjustment. And I'm a huge believer that the consensus of the sale of 30 million EVs by 2025 is just going to be way off base. I think the number is at 40, is it 45, is it 50? It's some huge number, right? It's an enormous number. But it's not mutually exclusive because of the lack of investment that's going into fossil fuels. That if you sell 40 million cars by 2025, you've still got 400 million vehicles, cars, scooters, motorcycles that are running on petrol, right? And that's an environment for $150 oil, $25,000 a ton copper. These sort of numbers, which have rather hefty inflation implications if they play out like that. So the climate transition does have consequences. Look, if we crack the code to zero cost energy, I mean that's a remarkable world that we would live in. But we got to get from A to B, and we're a lot closer to A than we are to B. And for all the opportunities that exist because of the climate agenda, there are plenty of externalities, and one of those major ones is a potential inflation externality.
I think it's really important to think carefully about this phenomenon that you just described of people overlooking the lack of investment that I think is really important. You just described a lack of investment in oil and gas because so many people have convinced themselves that oil and gas is going away because we're all going to electric vehicles. It's going to solve everything. Well, guess what else they're not investing in? It's the build out of the electric grid that would be necessary to support all those electric vehicles. So you can't replace the oil and gas with the electric vehicles that you don't have the electric grid to support. Yet we're making all of this huge investment because things like Tesla are incredibly cool and sexy and hot to invest in right now. But the products they're building won't work unless we do some other things like build out the electric grid that nobody has a plan for. What do we make of this?
Well, I think we've got to be when we say we, I think we've got to be very careful about this, right? So, if we as China, well, what you've just said is wrong because China's got a handle on that, right? Because they've got a plan, and they've got a industrial policy that revolves around this, and climate is a priority, and every facet of this climate priority has been thought out to the nth degree. Now, is it going to happen seamlessly? Absolutely not. When the coal industry employs as many people as the population of Norway, you've got some. This is not a seamless process. On the other side of the coin, I think you've described the US perfectly. It's going to be very, very problematic longer term. I mean, how do you encourage Shell and Exxon to build, to have electric charging stations inside all of their gas stations, right? How do you have a standalone charging center, which is a huge infrastructure spend across I-95 or Route 66 or whatever it is, to allow the current range of cars, which will grow significantly over time, no doubt about that. These are huge costs. I think Europe is somewhere in the middle. I think that Europe is, particularly with the help of the ECB, is in a better deficit position than the United States is in currently, and there's certainly more of an overriding priority to make sure that every facet of climate infrastructure is met. Again, doesn't mean it's seamless. But look, the problem the US has is that, you have this this polarized government, which means that very, very little gets done. You're on these rolling 2-year election cycles, which means that, if I put it this way, Eric, if I was to tell you that, after all the spending that we've witnessed in the last couple of years, that we get to the 2022 midterms, Republicans take the House, as they statistically will. Since 1938, there's only been 2 instances when the incumbent party has actually taken seats in the House. So let's assume the Republicans take the House in 2022. Are we discounting that there could be a Tea Party movement where they just turn around and say to Joe Biden, all these social programs, all this green agenda, no, we've spent too much money, we're shutting it down, and we go back to a Tea Party style movement? I mean, I can't think you can't discount on that. But the one given in all of that environment is the prospect of true structural change, whether it's climate infrastructure spending, whether it's tax reform, whether it's dealing with unprecedented income inequality, whether it's social issues, whether it's environmental issues and the like. Well, these things don't happen in an environment where you're on these rolling 2-year election cycles. And one of the big victims of that is what you just alluded to, which is, how do you have a full climate infrastructure in a world where politically it's incredibly hard to implement?
Well, and I think that related to that, too, is going back to some of those shorter-term macro factors. Let's talk about rates. We've got the Fed threatening again to taper. Are they really going to taper someday? Is this just talk? And what does the actual cost of capital becoming non-zero again, what's that going to mean to all these other trends?
Well, but again, there's 2 things we need to think about. There's tapering, and then there's raising rates. Are they going to taper? They're going to taper. They will. It's, I think it's pretty safe to say that there is no good reason to have emergency measures in an economy that is growing at the rates that the US economy is growing at. I think it is I think a better example is, I haven't heard a Fed official in 6 months tell me a good reason why QE is good for the real economy. Right? I know it's good for asset prices, but I haven't heard why it's good for the real economy. And, I think that we have a Federal Reserve that is so fixated on asset values, or preventing assets from contracting and thus tightening financial conditions, that everything revolves around that. And we can still have emergency measures, some 18 months after COVID began, when there's clear evidence that, economically we don't need that. So tapering is coming. Are we going to get to the Fed's unemployment targets by year end? That's touch and go. So you'll be tapering into 2022. But the scenario I've got, Eric, which again does have a lot of ifs to it, so please forgive me for this. But what do? We can be confident that growth from Q2 onwards, growth and inflation from Q2 onwards, is going to be slower than it was in 2021, just purely due to base effects. You will have, because they are a contentious midterm election coming up in November of 2022, which means that the chances of the Fed hiking rates in Q4 is relatively slim. So if you are going to get a tightening, hopefully it happens before Q4. But you would be clearly, if the Fed does raise rates in 2022 and 2023, I would argue that they are raising rates into a slowing growth environment, right? So my if scenario, which gets me to 10-year yields at zero in the second half of 2023, is as follows: that growth slows. The Fed doesn't get they may finish tapering, but they don't get a chance to raise rates because growth is continuing to slow because of base effects. Republicans take the House in 2022, and what we can be confident in is that they're not going to support reconciliation. Our deficit in 2023 is going to be a fraction of what it was in 2022. And, frankly, there's no free lunch with all of this. If you take a deficit from 18% of GDP down to 6% of GDP, 7%, which was the non-crisis high under President Trump, post-war that is, suddenly you've got in the scenario where growth is collapsing in 2023 because of fiscal contraction, and they haven't raised rates. And that's my scenario for rates for 10 yields to go to zero as we go into 2024 in the year of the next presidential election.
And how long do rates stay at zero or very close to zero?
I think it's considerable. I think it's a considerable amount of time. And again, I'm just, my structural disinflation biases are coming out thick and fast here. I think that, if you put it this way, if you've got a recession, if you have recession in late 23 going into 2024, a recession, by the way, that has been will be the first recession that we go into where we have zero interest rates, right? And here's where we get into, if we're looking 2 years forward, there's more questions than answers, right? So is there pressure because the 2-year note goes negative for the Fed to go to negative yields? Is there pressure for QE to look at other assets? Clearly what we've seen with quantitative easing this time around was absolutely unprecedented. Do we have the investment grade bailouts that we had, like we had with every other crisis that we have? And I'm not saying we have the makings of a crisis in 2024, but you are going into recession with your potential recession with zero interest rates, and that's not a good outcome for anybody. And then we get into the arguments, Eric, about Japanification, bad Western demographics. And I look at it this way: we keep talking about a normalized world, right? What does a normalized post-COVID world look like? Well, if we go back to what the world looked like pre-COVID, well, that was a disinflationary world, right? It was a deteriorating demographic world. It was a world where the dollar was doing very, very little. It was a world where growth equity outperformed. It was a lost decade for emerging markets. It was a decade where Chinese assets outside of tech did next to nothing. It's a world where Asian growth becomes a greater percentage of global GDP. But, at the end of the day, if we are normalizing, and that's normalizing deficits, normalizing with COVID, normalizing growth, well, the world we left behind in 2019 and before that was a disinflationary, low growth, poor demographic world. And that's the world I think we return to.
Well, let's talk about some of the knock-on effects and consequences of that, because one of the ways that some people value equities is by comparing the yield that the dividend produces to what the yield is on the risk-free rate, the so-called risk-free rate of treasuries. Well, if the treasury rate is zero, then in theory, equities are valued at infinity. And as much as you want to say, well, it's impossible for them to go to infinity, dude, look at the S&P chart.
Never say never. And Eric, by the way, what I'm about to say is going to annoy everybody, so please forgive me. And you've got so you basically have two arguments here, right? And by the way, of these two arguments, I tend to favor a watered down version of what you implied, right? So, if you've got rates at zero and they're stuck at zero, and you've got a 10-year yield at zero, assume, right? You've got two scenarios, theoretically, both correct and both polar opposite. Right. And those two scenarios are the one that you described, which is where you look at the world's best growth and cash generative companies and you think about what the value of those forward earnings are. And if you imply a discount rate of zero to those, then the implied multiple on the world's greatest growth companies is really darn high. So Microsoft is fair value at 50 times forward, 60 times forward, 70 times forward, pick your number, right? Could be infinity, right? Pick your number. That's theory number one. Theory number two is that, zero interest rates are implying where the growth dynamic is. And if you add a reasonable risk premium to equity risk premium to that low growth rate, you've still got a low growth rate, right? And that, what all we've done in a world that doesn't have further multiple expansion because you do have just a slower growth and slower profit environment, that actually is an era of weak returns in the years ahead. So both those arguments are theoretically correct and absolutely polar opposite. Because I focus a lot on these 20 transformative companies, and literally 15 pick themselves, and we can debate the others. That they are so, the cash generative nature of what they do, the dominance of indices for these companies like Microsoft and Amazon and Apple, etc., and also the addressable markets that they have. Again, if we were to wake up tomorrow and Amazon is the biggest rival in life insurance to a company like Liberty Mutual, would you be shocked? Probably not, right? Because the addressable markets of what they can do, because they attract the best people, they have the best data, they have effectively a negligible cost of funding. They can achieve a lot, and that's an environment for Microsoft in 5 years to be a $4 trillion company, and Amazon to be a $4 trillion company, and Apple being on its way when the Apple car comes out to be on its path to being the first $5 trillion company. Right, I tend to favour those arguments a little better than the low growth, the low theoretical return. But again, it's complicated and it's very annoying because they're just totally different outcomes.
So it sounds like the bottom line is the companies that are able to make a profit even in an environment where the entire economy is completely broken are the ones you invest in because you have no choice.
You have no choice. Yeah, you have no choice, and you have had no choice now. So,
and it explains
so
why the FANG stocks have seen this just extraordinary breadth divergence.
Yeah, and look, do I want to own Virgin Galactic? No. Do I want to own Peloton? No. I mean, there's a difference between the reopening stocks and these companies that are so structurally they're an imperative to everybody's life. I mean, I'm a slave to my iPhone. I'm a slave to Google. I've got my wife thinks I'm having an affair with Alexa. Right? I mean, we're all we're obsessed with this stuff, and we never. And these are so ingrained in the ways we shop, we travel, we communicate, we work, that I don't see a scenario outside of an inflation scare and spiking rates and flipping that that the value of those quality cash flows, flipping that on its head. I don't see why these companies don't continue to, at a minimum, earn supercharged profits and not only in the sectors they're in, but in future sectors as well. Now, obviously, tech regulation is a big part of this, and we've seen what's happened in China if you can regulate tech companies. But look, it took 10 years to get the antitrust case against Microsoft settled, right? I mean, do we expect the United States government to move any quicker against an Amazon that I've got no idea what that company looks like in 5 years' time, and I don't know what Facebook looks like in 5 years' time, and God knows how much money Google's going to make out of healthcare in 5 years' time. So, what do these companies look like in the years ahead? Put it this way: without regulation and without an inflation shock, the path to their continued re-rating to become $3 trillion, $4 trillion, $5 trillion companies, I think is a path that is well lit.
Returning to the megathematics, something you haven't mentioned yet is this digitization trend, where we've seen everything from digital currencies like Bitcoin that were designed to compete with government money, to governments beginning to look at central bank-issued digital currencies, to now really the hottest trend, I think, in finance is DeFi, decentralized finance, looking at using these digital bearer instruments in order to make other things, not just currency, but things like stocks and bonds and so forth, tradable just like digital currencies. Where is it all headed?
It's headed where you implied it was headed. Now, whether or not and again, I think let's separate the digitization and the cryptocurrency side of things, because I can be incredibly bullish on digitization and skeptical about the role of cryptocurrencies, particularly in a regulatory environment which is going to clamp down on this stuff and clamp down on it hard. So I think we should separate that. Look, I mean, the Chinese with their digital RMB, the PBOC referred to its role as controllable anonymity, right? Which basically implies you're going to monitor every transaction, right? So, if we can get to that stage, and that whether that's 10 years ahead, 20 years ahead, wherever it is, where the digital RMB or the digital euro, for example, can be completely programmable, where it can be sent to, it can be, so a digital can go to a part of Germany that's just had a flood, and there's a wave of digital RMB that expires in 90 days, digital euro that expires in 90 days, and they've got to spend it. You can go in and there and make interest rates on real estate in different parts of the country at a different level. I mean, stuff's extraordinary when we get there, and we eventually do, particularly in the Chinese case. And by the way, why at my core I'm such a structural disinflationist, because all these things, in terms of getting rid of friction, which effectively is what the crypto world claims and what the digital currency world will claim. But look, at the end of the day, the core of digitization is the eradication of friction. And at the end of the day, as we've seen with COVID, as we've seen with what happens if you smash a tanker in the middle of the Suez Canal, and what that does to friction of supply chain and all this sort of stuff, it's friction that creates inflation. Right, and digitization at its core, its path is to eradicate that friction. So I think that's important. Just onto cryptocurrency for a second. I'm a deep skeptic. I'm a deep skeptic in the context of, not that it's not going to play a bigger role in portfolios, and I think we're in that phase of the transition or the evolution of crypto, where people are saying it can't hurt to be 1% of the portfolio, and I think we're at that phase now. But look, the big thing for me, and my skepticism about crypto, revolves around regulation. It revolves around the fact that it is still, put it this way: if you were to go off and ban Bitcoin tomorrow, right? Now, sure, my old buddy Mike Novogratz will be a bit pissed off because he's got, because he's lost a lot of money, and the Winklevosses will probably be a little bit peeved as well. But who's really peeved? Well, every terrorist and drug and organized crime organization in the world is peeved because they've lost where they hide their money, right? So, we shouldn't lose sight of the fact that the cryptocurrency has been able to flourish because it has done so in an unregulated environment. And if you were to have a conversation with someone from the US Department of Defense as we speak, the reason North Korea has been so quiet over the course of the last 18 months is because their nuclear program is funded through their gains in Bitcoin, right? And these are the sort of things that really concern people in the Defense Department or the State Department and the like, that the cryptocurrency, being the unregulated entity that it is, has been able to avoid jurisdiction and there are some problems with this, this being the libertarian ideal, because a lot of bad guys have profited from that. And frankly, it's at odds with the goals and ambitions of not just the United States government, but the EU, and certainly, as we've seen, is China, right? It's, Bitcoin is done. It's going away in China right now. If you're a wealthy first tier, live in a wealthy first tier city in Shanghai, you might have an offshore account and you might be able to trade. That's fine. But locally, it's done. It's over. It's not going to happen because it is against the values of the party. And what I think is going to happen is that more and more regulation is going to look at whether or not cryptocurrency is a good thing for a Western society, and whether or not that is whether it should be prioritized or not.
Well, Paul, I can't thank you enough for a terrific interview. Before I let you go, please tell us a little bit about View from the Peak and the website, and what people can expect to find there when they check it out.
Eric, you've got me on a good day, because we've launched. We are doing daily live webinars now for View from the Peak, which is broken down into US-China series, which, as it sounds, is everything about China and the US-China relationship, and also Climate Transformed. So we'll be doing daily live webinars on Climate Transformed. You can register for events at climatetransformed.com or uschinaseries.com. And that's where we are. Again, it's me focusing more on these big mega themes and longer term thinking than the rolling 3-month stuff that I've been doing for a very long time.
Kevin Muir and I will be back as MacroVoices continues right after this message from our sponsor. Escrow.com is the payment system for buying and selling anything of value: cars, boats, airplanes, jewelry, gemstones, fine art, collectibles, intellectual property rights, domain names, bringing in shipping containers from overseas, or even buying and selling entire businesses. It's simple to use. Either party sets up the transaction, then the buyer sends the funds to Escrow.com. The seller is then instructed to send the goods to the buyer to inspect. Within the inspection period, the buyer can return the items for any reason. After that, Escrow.com pays the seller immediately. Escrow.com is the world's most secure payment system from a counterparty risk perspective because the funds sit in escrow. Over 2 million customers have transacted over $5 billion on Escrow.com, and eBay and Shopify use it for cars, boats, luxury watches, and business sales. It's available in the United States, Canada, and Australian dollars, euros, and British pounds. Never buy or sell anything online unless you use Escrow.com. Escrow.com is a subsidiary of Freelancer.com, listed on the OTCQX Best Markets under the ticker symbol FLNCF, and the Australian Securities Exchange under the ticker FLN.
Now, back to your hosts.
Erik, that was a terrific interview with Paul. One of the things about Paul that we didn't have a chance to discuss, but he's a hedge fund veteran that's worked for both Caxton and Moore Capital, two of the greatest hedge funds out there, Bruce Kovner and Louis Bacon. He's got a wealth of experience. It's just a pleasure to hear him speak. And one of the things that I found most interesting is that in this day and age, there's lots of people talking about all of the bearishness versus China, all the things that could go wrong and all the different problems. And he comes at it with a very different point of view. He's much more upbeat on China and views this not so much as the end of the world as an opportunity going forward. What's your take?
Well, I think this whole East-West thing is going to be a major conflict in the world for decades probably to come. But it's both of those things. I mean, if you're the West, things are winding down. We're seeing that there is a shift of power and wealth and influence from Western economies into Asia, and I think it's likely to continue. In any event, Kevin, let's move on to the post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, click the red button that says Looking for the Downloads. Kevin, we've got a couple of fascinating charts here. You've been away for a month. What's going on here with this economic surprise index, and why is it important?
One of the things that I found interesting, Erik, is that when I spoke to people and asked them how the month went, my bond bull friends told me, oh, the economy's terrible, the Delta variant's here, we're sliding back into the abyss, the sugar high is over. And what they would do is they would pull up to me and they would say, look at this U.S. Economic Surprise Index. And this is the Citibank Economic Surprise Index. And what it measures is the difference in the actual releases of economic numbers versus their expectations, meaning are they beating what the economists are forecasting or not. And ever since the 2020, let's just call it a spike higher after the initial problems, we had this spike higher, and since then it's been sagging. And what that means is that the market and the economy has just been disappointing in terms of, the actual underlying fundamentals of the economy have disappointed versus expectations. And it's very important to think versus expectations is the most important part. And let's face it, we all play in a versus expectations world. And then I have my bond bull friends telling me this, how bad the economy is. But then my bond bear friends are sending me a chart of the Citibank Inflation Surprise Index. And what this measures is how much inflation, releases are coming above or below the economist's forecasts. And this is a fascinating chart because this has recently hit an all-time high. Or an all-time high since they've been recording it. It's an all-time high for the past 2 decades. And this is occurring at the same time that we see the economy sagging.
How can that be, Kevin? How can we have, if these are both surprise indexes, they both go by a difference between what the expectation was and what really happened? If what we're seeing is the expectation was the economy was going to be really good, and that should lead to inflation, and it didn't happen, why would the inflation still happen?
Well, there's a lot of people are having trouble with this in terms of reconciling these two, because for the longest time, those two would move together. But COVID has changed the game. And COVID is increasingly making it so that we're having supply shocks at the same time that we're having demand drags. So these supply shocks are happening because people aren't returning to work, because we're having trouble with trade, countries and companies are turning off for a little while. So it's a very interesting and different macro environment that we're experiencing, because in the past, that if you got a situation where COVID would flare up and you would think that we would run into troubles, you might rush out and buy the long bond because you think, oh, here we are. We're in a situation where this is going to mean less economic activity, which is going to mean less inflation. However, if what's happening from COVID flare-ups is that economies are getting turned, off, or people are forced to stay home, or for example, let's say as the kids go back to school, that they all of a sudden are starting to get sick, and more women or men are having to stay home with them, we could see a situation where there's less labor, and this is in fact pushing the supply down at the same time that we're also having this demand shock. Now, in the past, we would see a situation where this would, a problem with COVID would mean people would rush out to buy the long bond. I think this has changed. I think that now COVID is going to mean higher prices because any sort of supply shock is in fact going to be monetized or in essence printed with more fiscal stimulus. So therefore, as COVID continues to flare up, and I do believe that COVID isn't going away anytime soon. Let's face it, when we were talking about COVID, let's say 6 months ago, everyone had these images that we were about to have the vaxxed and waxed summer or the shot girl summer, all these fun things where everyone thought we were all going to get vaccinated and then the world would go on in terms of back to normal. Well, what we found is that COVID isn't going away. It's still here in many different forms. And yet, as we go and try to get back to work, we're finding these supply shocks. So I'm looking at this and I'm thinking to myself, how does an investor take advantage of this? One of the things that seems very clear to me is that we're going to see a steepening of the yield curve, because we're going to see governments continue to try to print their way out or do fiscal regardless, stimulate on that side. Yet at the same time, as COVID stays here and as we have flare-ups of different sorts throughout the world, we're going to see the supply continues to be constrained. So I think that has all the makings of a government and a central bank that keeps rates, pinned to zero at the short end. And then meanwhile, bond investors start to get nervous and realize that although inflation, the big measures of inflation that everyone was worried about in terms of lumber and all those things, those are coming in and those parts were transitory. But there's other parts of the inflation story that don't appear to be transitory and look like they're going to be permanent, at least as long as this COVID continues to flare up throughout the globe. So I think it's has all the makings of a great steepener trade, Eric.
That's fascinating, Kevin. The way that I reacted to this when I first saw these two charts is I thought, well, wait a minute. If you look at what the economic surprise index is showing us, clearly the economy underperformed compared to expectations. And it has to be true that if the economy underperformed compared to expectations, that means that cyclical inflation had to be affected negatively. Well, if inflation is still going up and cyclical inflation, you can't really explain why it could be going up under that circumstance. The conclusion I come to is, boy, that must be secular inflation, not cyclical inflation. Because the reason you expect that correlation with the economic surprise index is if you're talking about cyclical inflation. If it's a secular inflation that's driven by expectations, growing expectations, I would say, of a completely different monetary policy regime looking forward, well, then it really doesn't matter what the economic surprise index is doing, does it?
Yeah. The other thing I'd just like to point out, Eric, is that everyone thinks that this has to be either a hyperinflation, a Weimar Republic type inflationary event, or it has to be an absolute collapse, like we have to become Japan. And I always like to say that the truth is going to be somewhere down the middle. And I look at this and I see a situation where I could see inflation going up 3, 4, 5%. And meanwhile, rates staying at the front end of the curve pinned to zero. So it doesn't need to be these extremes. And I think part of what we've experienced over the last 6 to 9 months is a movement from one end, which is when everyone was convinced that we were going to have the hyperinflation of the 1970s, to now we've flipped a little too much the other way, whereas like, oh no, looks like the Fed was right. It's all transitory. We're not going to have any inflation. What if the answer is somewhere in between? What if the answer is that we are going to have higher inflation and that the Fed is still not going to raise rates? That's what I'm looking for.
Well, I think that's going to be the very interesting tell is what happens when you have increasing inflation and you don't raise rates, because historically we've always raised rates in reaction to increasing inflation. We haven't had this problem where increasing rates would bankrupt the federal government if you did that. So it's going to be very interesting to see what happens. We're going to leave it there for this week's show, folks, and we do have a Research Roundup email this week. Now, those of you who have sent us article submissions, they may not have made it in this week because Patrick's off this week. He'll be back next week. We'll get caught up. So you won't find any specific research articles this week. This episode is brought to you by Abex Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole. And by escrow.com, the world's most secure online payment system from a counterparty risk perspective, because the funds sit in escrow.
So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how to make the program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. That is Erik spelled with a K. And you can follow Patrick at Patrick Ceresna. On behalf of Erik Townsend, Patrick Ceresna, and myself, Kevin Muir, thank you for listening and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.